This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and welcome to our monthly open house Q&A, which for those who are listening live, you're going to have an opportunity to ask me questions and submit stock symbols when I give you the signal to do so. Just as more like preliminary instructions on what to do, when I ask you for a stock symbol, please try to submit it as quickly as you can on cue, because we have a scrolling Q&A box, and if you put it in too early, it'll scroll past me and I won't get to see it. When you do submit your stock symbol, please let me know what your intentions are with the stock. Either you're long it already or you're thinking about buying it, because then it'll help me help you better in analyzing the prices and showing you how to manage risk using the candle charts. Before we get into the rapid fire stock analysis part of the program here, I'd like to just go through the general markets to show you what's happened today. We had a couple of things occur that normally don't happen, and I want you to be very much aware of that from a risk management standpoint. And it starts with the diamonds. This is the Dow Jones Industrial Average ETF, ticker symbol DIA. And these lines that I have on the chart are the lines that I drew from last week's market report, where this line here, hopefully you can see my cursor right there circling it, this line right here is the newly established role reversal support level. And what that means is back here, back on, that's December 31st, right, last week of December of last year, we hit a resistance point, and then we hit another resistance point at the beginning of the month, April 1st, and it pulled back. Now, when you have a former resistance line that is then broken, in other words, we have a breakout above that, former resistance turns into new support. So this horizontal line acts as a support level. This line above that is drawn from the high back here from last July, which is the most current resistance point right here. So you can see that the horizontal lines are giving us more of a trading channel or a trading range to look forward to. And with that said, as I zoom in, you'll see the interesting thing is that we had a bullish engulfing pattern here. Now, if you follow along with the Market Guys reports for any length of time, you'll know that bullish engulfing patterns work out to be bullish about 80% of the time. So what that means is they're not 100% accurate, but they're pretty accurate 80% of the time. And usually what we look for in a bullish engulfing pattern is we usually look for high volume when the pattern has formed. And if you look straight down, I'll zoom in here for you. Today we had a pretty significant green candle, but the volume down here was about 20% less than what we had in Friday's trading day. So I can't put too much faith into that bullish engulfing pattern and say, okay, I'm going to take all my remaining cash and go long here, because the volume does not support the move. That's point number one. Point number two, there's a gap right here. So this gap was formed on April 13th, and that was Wednesday of last week. The market gapped up, and when it gapped up on fairly high volume, and then the volume started slipping. And I pointed that out in the weekly market report so that our viewers could really pay close attention to volume, because volume really is the leading indicator that I've been paying so much attention to over the past 30 somewhat years. Volume supports the move. And so if you see a bullish engulfing pattern, and it's on fairly weak volume, that means just don't put that much weight into the buy signal. Instead, protect any existing long positions and raise your stops or put some type of option position in to hedge yourself, whatever it may be. It means when you see low volume, it means the buyers are not as committed as they would be on a higher volume day. Okay, so keep a very close eye on that. The second thing here is that resistance isn't that much further away. I mean, we're talking for the Dow, maybe we could see a little bit higher, but I don't think much higher. My forecast from last week is that even if we go a little bit higher tomorrow, Wednesday, I think we're going to come back and fill this gap. And gaps fill a large majority of the time. And again, that is 80-20 rule that you can follow. For the diamonds, for the VIX, there's probably a slightly higher than 80% fill rate. So, weigh that into the whole scenario here when you're taking a position. Before I go to the other indices, I want you to see the monthly chart of the diamonds. And you'll see that there's more or less a consolidation area up here where we're seeing a series of highs and major resistance up here, pretty much where I drew that resistance area right around 181 level. Remember, the diamonds is 1/100th of the actual Dow. So 181 would be like a Dow 18,100 level. And so this whole area up here is heavy resistance, number one. Number two, look at the monthly volume. Now, we don't have that much time left in April, but from the looks of the volume here, this volume is dropping quite dramatically on the monthly level. So even as we go higher, and you can see these green candles are moving us higher, this volume is something to be very concerned about. So when you turn on CNBC or any of the other financial programs and you see the analysts all, with their horns up as they're playing the bull strategies, I just would not buy into that, hook, line, and sinker. I would be very, very cautious as we see the volume dropping. Before I go on to the next index, I want to tell you that last night I rented the movie The Big Short. I don't get a chance to go to the theaters all that much, but I heard a lot about the movie and the housing market and the bubble and everything that was predicted. And it's amazing how much truth was in that movie with regard to manipulation in the market. And there's no question about it. The housing market was manipulated to the point of collapse, and then it was almost like a concerted effort by the Fed and the federal government to bail out the banks that were in trouble, and basically move forward with quantitative easing to pump money back in. Now, the reason I'm bringing up that movie, if you haven't seen it already, I would strongly recommend you go to Redbox and spend $2 to watch it. They did a very, very good job explaining the markets and the contracts that were being created to hedge against a collapsing housing market. But I want you to pay very, very close attention to how the general population was fooled into thinking everything is okay. And again, I bring that up because I'm still hearing a lot of bullish indications from analysts that, okay, we're really going to just keep on going in this bull market, when I'm just seeing so many signs of a major, I'm not even going to say a collapse really, but a major correction in the market. I think that it's very reasonable to think that we could very much correct in 50% pullback. And here's why I say that. If you look at 2000, and I'm going to draw some horizontal lines. This is year 2000. We heard the Y2K scenario there when everyone thought the world was going to come to an end. And Y2K, 2000, New Year's rolled around, and we didn't see a collapse right away. In fact, the end of the world did not take place. Computers didn't shut down. But if you look at what followed in 2000, we had a significant pullback in the market. And then 8 years later, what happened? Just like The Big Short, the movie, the housing bubble burst, and we had a major collapse in the market to be followed by a fairly significant bull market. Now, here's what I want you to look at. 2016 is right here. I could probably move my charts a little bit and adjust that. Let me go down. Here we go. So here's 2016. I'm going to draw a vertical line right there. And if you haven't picked up on this already, we're in an 8-year cycle. 7 to 8 years to be conservative, but if you look at the chart, we're in an 8-year cycle of corrections. If I had more history on the chart, you'd probably see that in 1992, there was a similar effect 8 years prior to the Y2K bubble there. But every 8 years, like clockwork, we've seen for the past 20 years almost, we have had a major pullback in the market. So if I'm talking to you about a correction, how am I coming up with a 50% correction move? Well, I could just go back and look at the previous corrections. 2000, we pulled back here significantly. We pulled back. All I have to do is draw a line parallel to what I've seen in the past and go almost the same distance, and you see that this could pull us back to Dow 11,000, 12,000 right here. So conservatively now, we could pull back. We could pull back 6,000 points, maybe 7,000 points in the Dow before we find any kind of major support that would make me feel comfortable getting back in. Now, if you're an investor and maybe what I've just said makes you feel a little uneasy, let me tell you that there's lots of opportunity. Like the traders that made money when the housing bubble burst, there are so many contra funds or bearish ETFs that you can get into that would allow you to profit on a pullback that you might want to at least explore those ideas and being able to make money on the way down. Now, I often talk about gold and silver. I'm going to put up SLV. Before I talk about silver, I'm going to tell you that I have a very large position here, so there is some bias, of course, when I look at this, and you can see that since April of 2011, so for the past 5 years, silver has really been in a significant downward trend. And I'm going to take this trend line and I'm going to connect as many of these highs as I can, here to here to here to here, and I'm more or less extrapolating and drawing that trend line down to even connect some of these highs. And you'll see that recently we've broken and have traded above the trend line. So we've broken beyond, I'm not going to say we broke out because it's kind of just, we consolidated sideways, but we're now moving in a sideways direction and no longer in a downward trend for silver. Now, our subscribers, a lot of them are in a silver position because the the silver looks fairly strong at these levels, and when you look at production of the silver mines and the other mining stocks, because silver has been so low for such a lengthy period of time, the producers have cut back on production, which in turn cuts back on the inventory. Now, the reason I'm pointing out silver more than gold is because silver could actually be considered somewhat of an industrial metal. It's still being used in industry. It's still being used like gold in computer parts and such, and circuitry. It's not just a currency that people put in their safe and hang on to, and it's not just a collectible for silver coins. It's actually a metal that's being consumed in many different ways. And as we see the levels of silver starting to go sideways, this is just one of those opportunities. And this pattern that I'm showing you right here is one that you want to look for in other stocks and indices moving forward. Don't just look at silver and say, okay, I'm going to take everything I own and buy silver with it. Look for other markets that resemble the chart of silver, and then put these charts on the sidelines, or at least put the symbols of these stocks in some sort of a watch list and keep a close eye on them. Because when the general markets start to move into a correction phase, you want to be able to put your money to work in another direction so that it's not just sitting in cash and in an idle position. You want to try to get the most out of your profits in even a down market. And don't be afraid. Don't be afraid to jump in when it looks like all hell's breaking loose, excuse my French there, but when it looks like panic is setting into the market and you even see capitulation, understand that even when a major index is going down, there's always going to be a handful of stocks somewhere that's going up. So those are some words of wisdom I like to just put out there for you, because you shouldn't be panicked and you shouldn't feel scared about putting them into the market to make more money. You just have to know where to direct your funds and how to protect yourself along the way. Okay, so that's the silver market. Now, I want to look at the VIX because, and I'm not going to go through every index here. You can follow free weekly market reports at the end of each week. But this is the volatility index. And the volatility index is a contrarian indicator that is used as a leading indicator, which measures the volatility for the S&P 500. So these are my lines that I drew from last week. And you can see as I zoom in, today we had a red candle. And why is that? Well, as I mentioned before, we had a bullish engulfing pattern in diamonds, and we had another bullish engulfing pattern in the S&P. So this is going to be the opposite of what we saw in the index. Remember, it's a contrarian indicator. Now, this does not trade like a stock. It's more or less a scale measuring emotional volatility and premium within the markets. And you can see that this is a 20-year monthly chart. And I get pretty excited about this because whenever we see the index trading at 20-year lows, that generally tells us that we're reaching a market top. And understand, remember, this is a leading indicator. It's contrary to the underlying S&P. So when we see the VIX dropping to lower and lower levels, that is our signal to get ready to get out, or get ready to short, or get ready to buy puts, or get ready to go into bearish funds. That's what that means. When this is on a low, that's an extremely bearish signal for the market. And the reason for that is when volatility drops, it tells us that the investors are getting complacent. They're okay with sitting on positions. They're not really doing anything. They're not really buying more, but they're not really selling anything just yet because they're still hovering around a profit area in their stocks and portfolios. So what happens is the volatility comes to almost a halt, and we slow down because the buyers and sellers are trying to figure out what's going on. And that is usually the signal to get ready to take action. Because when volatility starts increasing and we start seeing it go from 13 to 30 to 45 to 60, that generally means that the market is now in full-fledged bear mode, and the sellers are really starting to move in an emotional way. Okay, so I took about 18 minutes there to describe the market to you and what to look for. Now's our time to put in some stock symbols. So if you want to put in stock symbols starting right now, go right ahead and tell me what your position is. So Ron is first. Actually, let me go before Ron. Let me go to Larry. Larry is asking me to look at SSRI, and I'll take these in order as they come. Okay, so you put your stock symbol in, I'll get to that. So, all right. So Larry is asking me to look at silver. This is Resources Incorporated, and he's looking, so waiting for a pullback to cover a gap at 581. Now, let me zoom in here because this is a monthly chart. Let me go in. Now, you know, if you look, Larry, there's a bullish engulfing pattern on the monthly charts. You got to watch that. But let's go to the daily chart. This one, it could very well pull back. And I see the gap that you're talking about here. The gap down here is a gap here, and then there's another gap right here. Now, again, this is a recorded web seminar. So for our members, you'll get a recording of this, so you don't have to take such stringent notes. But I would say, Larry, I would go along with your idea of a pullback, short-term now, with a long-term bullish bias. Okay, so I think there's a good chance this could pull back, fill the gaps, and then go up. And the reason I think this could pull back is that you see the volume dropping. This is, again, a dramatic drop in volume, number one. And number two, these small little candles here, especially today, that's called a spinning top. It's a very small body candle. You see that little box of green and the shadows that protrude from above and below that candle. That's usually a sign of indecision. It's a close cousin to doji. And when you see these on low volume, it generally means the buyers are getting tired. So I would say wait with your buying power. Look for a gap fill point. You know, listen, Larry, if this first gap fills around 630 or so, I wouldn't be opposed to buying half of the position because you could see a little bit of a bounce here, and that gap could very well stay open for a while. But this would be a good accumulation area right here, again, because once the gap fills, there's an 80% chance it could go the other way. Now, if you buy half the position here, you still have half your buying power, so if the second gap fills, you can buy the other half and then hold on. And then you could put your stop somewhere below 5.25. But right now, I would go along with that, Larry. I think a pullback right there, just like you mentioned, because of lower volume. And if you're going to put some money into that, just don't put all of your buying power into one position. Okay. Now let's look at ARGS. That's coming from Ron. Let me see, ARGS. And Argos Therapeutics. Now, I don't know. Let's see. You're looking for an entry point? Okay. Let's look at this for a second. Number one, I see a long stretch of green candles right there. Let me zoom in here for you. Obviously, there was news that came out on this stock. Otherwise, there wouldn't have been such vertical movement. But we have 1, 2, 3, 4. We have 5 green candles in a row. Now, if, again, you've been following the market guys long enough, you'll know that when you have that long of a stretch of green candles, we call that a stale green light. And what that means is that we're expecting a red candle to show up here any day now. This long shadow above this candle leads me to believe that the sellers are starting to give the buyers a fight for their money. When you see long shadows above the candle, it generally means that the stock could pull back, or it's about to pull back. So I know I see a big volume day right there, but this long shadow tells us that the big battle came with the buyers and the sellers fighting on this day. I think that you could very well see a pullback on this one, so I wouldn't race in to buy it. What I would try to do is wait for a bounce off of this former resistance, now turned to support. Here's your role reversal area. So right around 836 is where I would be a buyer. But, okay, hold on, here's the big but. I would wait for the red candles to show up, and I would wait for a pivot point to form before buying into that. Because if this support level doesn't hold, your next support level is down here around $6, which is also a very well-established role reversal support. So if you see a pivot point forming here, you can get in there. If it falls through that support and starts finding new support here, then this area would be your accumulation area, and I would put your stop somewhere below these lows. Okay, using the 1% rule, you could let a stock drop with a significant percentage in share loss, share price, but you could still limit your loss to 1% of your account. For those of you joining the Market Guys for the first time, on the Market Guys website, we have a video library you can go to. And I think the most important video is the 1% rule for managing risk. So be sure to visit that. You know, we have a lot of people on this web seminar. How many of you joined, just by a show of hands, if you could hit the raise your hand button there, how many of you joined as a result of the Twitter promotional campaign that we launched? How many of you found this by Twitter? Just curious. Anybody find this by Twitter? Okay, let me see I just got a beach ball effect. There we go. Okay, just a handful of you found this by Twitter. Okay, thank you for that. And we're going to continue to promote on Twitter. I find that to be the new social media opportunity for us. I think a lot of people pay attention. There's a lot of traders that are on Twitter. And so thank you for joining us here today. Let's go with Jack. Jack is long it at 6:30. Let's go to AMZN. AMZN. Go into the daily charts for Amazon. Long it at 6:30. Okay, now Jack, we are right at a resistance point. Right at a resistance point. In fact, this, I believe, is the forecast that I made last time I talked about Amazon. And you can see we have 1, 2, 3, 4, 5, 6 green candles in a row. The volume is pretty strong. So here's what I would tell you, Jack. If you have any kind of a red candle below 637, any kind of a red candle would be your signal to take a profit, especially if it's on lower volume. If you get a breakout over this resistance point, then you're going to move your stop to just below the newly established support level. So again, to reframe that for you, we have a resistance area right here. If it breaks through resistance, resistance turns to support. So if you get a breakout over that, then you're going to need to protect yourself very close to where you bought the stock. So at least protect your break even if it goes higher. The good thing for you is that the volume is higher today as it's approaching that resistance point. So the key here, though, is protecting the profits that you currently have on this stock. I mean, it's a higher price stock. You're up only by about $5, which percentage-wise is not a whole lot of profit percentage-wise. But be really, really careful with that, because Amazon is one that could shift on a dime very, very quickly. Okay, Mazier, I hope I'm pronouncing your name correctly. Forgive me if I'm not. You're looking at Google. You're looking for an entry point in Google. And let's see. We have, again, this is a pretty volatile stock. It has gone through a series of gaps and gap fills. We have a green candle here, but the green candle is on lower volume. Here's what I would suggest. Here is a breakout point of these highs, right around 750 or 755, right around there. Here's resistance highs. We broke out. I would expect Google to pull back a bit, because lower volume tells us the buyers are getting tired. I would wait for a pullback and a bounce right here. So if you're looking for an entry point, this area of support, you remember, you want to be buying over support. You do not want to be buying when a stock is breaking down below a key support level, because that means the stock is failing. Okay? So if you're looking for an entry point, I would wait for it to pull back a bit, wait for it to bounce. On the bounce, buy it, and then put your stop right below there. I wouldn't go too far down, because, again, Google could aid you a few years if you let this position go against you. It has that much volatility. I mean, look at this. Imagine being a buyer back here. back in February when the stock is trading around 780. And remember, this is a daily chart. So it goes from 780, it drops over 110 points in 4 days. I mean, that's the kind of volatility you can see with Google. So what happens is it takes a while to build up in price through the price trends, but it comes down very, very quickly. And fund managers especially are very quick to get out of this because, if it drops down below major moving averages, they get out. So I think, if you're a real risk taker, this is a stock to be in. But I'm telling you, there are many other stocks that give you good percentages of return without having to suffer, through so much volatility here. So you might want to pursue that, and keep an eye on the market, guys. These web seminars, I can guarantee that by the end of today's session, we're probably going to come up with some good buy ideas just by those submitted through the Q&A box here. Okay, so Alan, let me see, it's LOCO, is that the ticker symbol? Let's see, LOCO. And this one doesn't look like, if you can resubmit that stock symbol, I don't see that matching your price. You said Loco Pure and 445 stop at 340. I think I have the symbol wrong, or you have a typo there in the Q. Let me see, PUR. Let me try that one. Is this it? Perhaps no. That's it. Maybe you could submit the stock symbol over again, and I'll take a look at that. Okay, look at Joy, Joy. This is Paul looking for a long position at 19 with a stop near 17. Okay, I see where you're going with that one, Paul. Looking for a long position. You're waiting for this one to break out. And I would concur with you on that one, because let's test the audience. Here's a resistance point right there. I'm just going to draw that horizontal. Can anyone tell me what type of a price pattern this is right here? Can anyone tell me? Let's go. Ken is the first one to react. Let's see if anyone else is right there. Ken, you're right, by the way. Let's see if anyone else. Dave, Jeff, Dylan, Bill, Larry, you're all right. Wow, look at all the technical analysts on this call. Yes, this is a cup and handle pattern. This is absolutely a cup and handle pattern. Now, let me tell you that if you are looking at a cup and handle pattern as a trade opportunity, like Paul is, you want to wait for the stock to break out over, this is called the brim. This is the cup. Imagine a teacup. Here's the little handle where you put your finger, right? The brim is the resistance point. So that's right around 1845. So a close, Paul, this is what you're going to look for. You're going to need a closing price over that. 19 is a good one, because if it closes over 19, this thing could very well go up to 24 or higher. And so I would wait for the breakout. 17 is a good one, because if you put your stop at 17, the brim, acting as resistance now, will then roll reversal. Remember, the resistance will reverse and turn into support. So if you buy it at 19, put your stop at 17, you're doing yourself a big favor. Now, if you're using the 1% rule, you could let that stock drop $2 after you buy it and still only lose 1% of your account. So again, in just a brief explanation of this, for those of you who are new to the 1% rule, Paul is willing to lose $2 per share. If he buys it at 19 and has his stop set at 17, he's willing to lose $2 on that trade. So if you want to limit your loss to 1%, all you have to do is take the $2 and divide that into 1% value of your account, and that will tell you how many shares you get to buy. Okay? So if you risk $2 per share and let's say your account, the 1% of your account value is, let's say, $1,000. Let's say you're trading with 100,000 and 1% is 1,000. Then you can only buy 500 shares of that stock, because 500 shares times $2 risk per share would be your $1,000 loss. If you're trading with $50,000, then you can only buy 250 shares. I would round down to 200. I don't like the odd lots. And then you just play it that way. So there's no need to overbuy your account just because you have the money in it. Use the 1% rule to manage risk, and it'll help you quite a bit with limiting your loss along the way. So Paul, hopefully that helped you out. Folks, this, thanks to Paul suggesting this, this is one you might want to put on your watch list. I mean, we didn't even look at the weekly chart on this one, did we? But look at that. The cup and handle still shows on a weekly, and you could even go so far as to say that this is almost inverted head and shoulders, with the shoulder, head, shoulder here. And this could even be your neckline, you see? So this is one of those stocks I would put on a watch list. I would not buy it until it broke out over resistance, and even then I would be very, very protective of a position like this. Even though it's a cheap stock, you don't want that one getting away from you and going against you. Okay, so Jeff is looking at VRX. VRX. And Jeff is thinking about getting in and putting a stop around 25. Now, Jeff, before you do that, excuse me, take a look at this trend. Boom, here's a high, here's a low. Boom. That's a downward trend, number one. Now let me erase this line and try to draw you the actual downtrend line. And this could be a good lesson for those of you who are learning how to draw trend lines. I could take this high, or I could even take this high. Let's take this high, and I'm going to extend this and try to connect it to as many of these highs that I have down here. So I'm trying to connect as many of these dots here, maybe go a little bit further here, and go down. I could even go down just to right around there. Now, here's your downtrend line. This stock has not yet broken out of its downward trend. So you got to be really careful about this one, because not only is this a pharmaceutical stock that is subject to whatever news that pops out on it, but if you look at the weekly chart, I'm going to leave that trend line in place. This stock has taken an absolute beating, and I'm going to have to even go back further to find out if there's any major support. Oh boy. This is a hard one for me to get into, or even for me to recommend anyone get into, and here's why. You have to think about, this is a 20-year chart. You have to think about this for a second. Since 2013, here's how I'm coming up with this now. When this stock first broke out here in 2013, it went into a vertical rally that looked like it wouldn't quit. But as we all know, vertical trends cannot sustain indefinitely. Eventually have to come back. But you have to understand something, that for anyone, actually at this point where the stock is right now, for anyone who has bought this stock after 2011, you have to understand, anyone who's bought this stock over the past 5 years and is still holding it is losing money on it. So what's going to happen is that the investors themselves will become this stock's worst enemy. That's called overhead resistance. That's when the inventory of those who hold it, they're not looking to make money on this anymore. They're looking to get out of the pain, especially these people who bought it up here around 240 and are still holding it at 33. People who are holding it up at these highs, they're not looking to make money. They're looking to get close to break even. So anytime the stock rallies, you're going to have these people selling into the rallies. So I don't like that one at all. I think for a $33 stock, there's a lot of other companies you can get into. So be really, really careful with that one. I don't even want to suggest getting into it. So if you haven't already, I would say find yourself a better candidate. Okay? Hopefully that helped you there, Jeff. Okay, now, Bill Wilson is looking at TASR. Now, before I go to the daily chart, let's just for the heck of it, let's see. Let's see, Taser International. This is a 20-year chart of the stock, just kind of getting an idea of that. Let's zoom in. Look at the weekly chart. Oh, interesting. Here's something that might be an opportunity for you, Bill. Okay, so what you folks can't see is I have a control panel that keeps getting in the way, so I have to keep moving that. Okay, so Bill, your idea is you don't have a position, but you're thinking about buying into it. Now let's look at this. If you look back at history, you'll see that very rarely does this stock gap. And again, to define a gap, here's one right here. Back in August of 2014, the stock gapped up. Now again, following the rules for gapping, 80% of the time, gaps will fill. So here we go. Here is the gap fill point. Now, the other part of gap fills and the rules for gap trading is that after the gap fills, there's also an 80% chance that the stock will reverse the other way, which in this case it did. Once the gap filled, it rallied. It reversed and went the other way. Now again, looking back at the past 3 years, there's only been one other time that the stock has gapped, and we've all looked at it here. So what's happened now? Back on, that's the week of February of this year, stock gapped up. Well, what's happened recently? Look at that. The gap has filled. This week, the gap has filled. So there's an 80% chance that this stock will move up. Now remember, this is on a weekly chart now, folks. So if you're looking for a buy candidate, this is one you would at least put on your watch list. Now you can't do anything yet until we look at the daily chart. See? Now, look at that. Here's my gap fill lines from the weekly chart. You can see that I could probably move that up a hair, but this is a perfect fill. And look at what happened on the daily chart. Today, it gapped down. By a slight bit, it gapped down. Now, this minor gap, as small as it is, will most likely act as a magnet to draw the stock back up. And that gap fill point is right around 19. So, you're talking about 2.5% value in price increase if that gap fills right there. And the good thing is you have a green candle and higher volume, which tells us the buyers are coming in. So, Bill, I would be comfortable buying into that position right there as long as you have a stop somewhere below the support level. So if you buy the stock, let's say you buy the stock at around 18 or actually 1780, I guess that would be. Let's see. That would be, I'm waiting for my price box to pop up there. It did not do that, so I'm going to go here. So if it gets to anywhere around 1780, well, actually, the support level would be the low. Hold on, it's 1780, right? So if you buy that stock, I would put my stop somewhere, maybe, I would put my stop maybe $1 below your buy price, and then let it ride. The only thing is here, your resistance line is going to be up here around the $20 level. So you're not going to be taking this one for a long ride. This is a short trade because what's happened here is the stock is in a trading channel. Support right here, as we mentioned, right around 1770, 1780. Resistance is up here around 20. So if you're buying it at 18.5, you're talking about $1.50 profit potential before you're looking to get out and take your profit. So that would be one that I would absolutely consider, but you got to keep your stop in place. All right, Bill. So hopefully that helped you out. All right, now Ken is looking at Bank of America, ticker symbol BAC. Now you have to understand, folks, I'm not right 100% of the time. I'm my percentage of accuracy is in the mid 80% range, like around 83 to 85%. So, this is the analysis that we make uh, based on what the charts are telling us. But there's 15% chance that what we're saying here is not going to pan out. So when you're looking at a chart, you have to prepare for the 15% or 20% of the time that you're going to be wrong. Now Ken is looking at Bank of America, and let's test the audience now. Can anyone tell me where I would draw my support line for this particular stock? There's two different areas, but looking at what Ken's giving us here, who would draw that support level? Well, actually, you give me a couple of points, and I'm going to draw some lines and see if they're where I would put them. Let's see. Who wants to be the first one? Okay. Dave says 15.5. Now, support, not resistance. 15.5 is going to be above. Support is usually below where the market is, Dave. So let's look for. Okay, so Ron says 13. Okay. Phil says 13. Ken says 14. That's Ken, I could see that as being a support level, and I'll show you why. Steve Yeager says 13.75. Nathan 13. 12.5, 13, 13.30, 12. Okay, here's where I would draw my role reversal. My first role reversal would be from that high, breaking out to this low. See, here's a role reversal. Again, the role reversal is going to look something like this. It's going to look at a resistance, broken, and then form a resistance, turns to support. So I'm drawing that for you in what a role reversal line is going to look like. I could have been a little bit closer on this point here. But you can see this resistance line represents this part of the role reversal line. It rallied up, comes back down, right here it bounces. So this level right around 1274. So Larry, you're really the closest. Anyone that's at 1275 is probably the closest for where I would draw the support level. Larry drew one. I'm sorry, who was it that drew it up there? Steve. No, who said 14? Ken said 14. And I can see where Ken is drawing his from. Here is resistance, resistance, resistance right there. So this is a near-term role reversal. But the reason, Ken, where I wouldn't use this as the support level is I'm actually expecting this gap to fill. So I think this stock could very well come back down to fill the gap before going higher, like that. And this would be the area where I would use that support level for my stop loss point, okay? So going back to what Ken is suggesting, Ken, if you're thinking about buying it, I would be a buyer somewhere around the gap fill point. So that would be right around 1333. And then I would put my stop probably $1 below that. So if I had a $100,000 account and 1% of that value is $1,000, I'm giving myself $1 risk per share. You would not want to buy more than 1,000 shares of that stock if you're using $1 stop on a $100,000 account. Okay, so hopefully that helped you, Ken. Yeah, the bank stocks, interestingly enough, they have tons of volatility. I don't know what the Fed's going to do with interest rates, but as interest rates start to creep higher, obviously that's going to have an effect on the bank stocks. So expect some volatility there. Now Jack is long SDS at 21. Let's talk about that because this is a position we have, especially the option traders. Now SDS 21 is up here. SDS is a ProShare Ultra Short, so this is a contrarian indicator to the S&P. This works directly in line with the VIX. Let me show you something here, because I have a long position here that I'm funding with other positions. I'll get to explain that in a second. This is the SDS, and you can see that it's starting to consolidate at these lows. This is actually the beginning stages of what's called a rounding bottom or a salsa bottom. And you see that now this is a monthly chart now. See how the price has been drifting lower, but look at the volume. You would read this just like any other stock. This is a significant drop in volume. This isn't a little drop. This is significant. Even if over the next week or so, the stock, or the next 10 days, this volume increases, it's still probably going to be lower than the previous months. So as the volume drops, that becomes bullish for SDS. So Jack, if you have this position, especially if you're trading options, fund this position with other positions, because eventually it'll reverse and go back up. SDS cannot go to zero. That would mean that the volatility would have to go almost to zero, and that's never happened before. So keep an eye on that one. Jack, how many shares do you have? Put that in there. I don't have to disclose that to everybody, but I want to make sure I'm helping you correctly. I don't want you to be overloaded in that either. So keep an eye on that. Folks, if you want to submit some more stock symbols, go right ahead. We could put that in there. I'm getting a little bit of a delay. Once again, Bill, I have no idea why that's happening. I don't know if it's the whole screen's locked up right now. Bill, just another check. I'm just doing, make sure we get a good recording here. Bill could still hear me. Just send a text message to me. I'll probably get your text before I get the unlocked screen. Okay, Bill hears me. All right. Now, screen just unlocked, and let's see. Ken is long USO. He's long calls USO. I'm going to go in there and look and help Ken. USO. Here we go. And now this is a monthly chart. Let's zoom in and let's go to a daily chart. Okay, he's long USO and he's long the $11 calls. Now, Ken, please don't tell me you're long the front month calls, because that would be a big mistake. But tell me, and then maybe you can tell me what price you paid for the calls. All right, so USO is an oil fund. Now, if you've been following along recently, I believe that oil is at a key support level. I'm going to remove all these drawings because that's a step down pattern there. You'll notice that on USO, we're seeing higher lows, but we're not yet seeing higher highs. In fact, we're seeing a resistance high right around this area. So this is a triangle pattern. Now, for anyone that's long USO or long calls in USO, if you're long the $11 calls, again, I don't know what month. Let's see, long August. Okay, I still don't. Oh, all right, you're long the January 2017. All right, that's good. Now, here's the good news for anyone who's long or long calls in USO. By the way, this is one I would put on your watch list. In fact, I'm going to do that right now, because this one, in my opinion, looks so good that I'm going to at least watch it. So watch how I do this. I'm going to put USO in here, enter, and now it should be on my watch list here. Let's see. Did it track? There it is. Okay. Now here's what I expect to see in USO. There are two gaps here. There's one here and there's one here. Let's start with the closest gap. There's a good chance that USO could drop a little bit more, fill the gap. Then what's that 80% rule we talk about? 80% of the time after a gap fills, it reverses. And I think it could do this. I think it could go back up. Now, the interesting thing about USO is right now it's caught between two gaps. There's a gap above the market. There's a gap below the market. Now, be careful, because USO, if you look at the history of the stock, it does have a tendency to gap. So you can't be caught by surprise here and say, holy mackerel, oh, I'm going to have to trade this gap because, you know, there's a gap. No, don't just trade the gap for the sake of trading gaps. This one gaps quite a bit. So it's not out of the question for this smaller gap to stay open, because there are several times that the stock has stayed open with the gaps. However, the triangle pattern is what I want to pay more attention to. We see a green candle. if this tomorrow, especially if this trades down and then winds up higher and you have another green candle but with a lower low, that would be your buy point. And then what I would do is I would put my stop somewhere below this low. So if you buy it around $10, you're going to put your stop about $1 lower, maybe $1.20 lower. Because if it breaks down below the support level, it's right back into a downward trend. But this one, being that's oil stock, oil inventories, although they're high right now thanks to Iran and what's going on with them loosening the pumps, I think that oil consumption is also at a high because there's more people using oil than ever before because it's getting cheaper. People are taking vacations. They're buying the big fat trucks. The ocean liners are taking people to the islands, and they're burning up oil like crazy. But eventually, I think what can happen is oil can start moving up again. USO is on a 20-year low. Now, why am I showing you the 20-year chart? Because look at the volume again. When prices are going down and volume is going down, that is bullish. And this is, again, a dramatic drop in volume month after month after month, which tells us that the sellers are losing momentum. So we've had a couple of trade candidates that I would put on your watch list to at least look. Make sure you wait for the trigger points. And by all means, make sure that you're using stops using the 1% rule. One final thing before we end today's session. I can't believe an hour has passed so quickly. But we at the Market Guys, our goal is to provide you a world-class financial education. This session, this web seminar that you've experienced is absolutely free. We are going to continue to promote this. So feel free to invite friends, family members. I'm going to offer something a little bit different. If you are a student at a university, or if you're a teacher or know of any teachers who would like to have a free webinar just for their class, let me know. I am more or less an adjunct teacher at University High School in Orlando, and I've been doing virtual seminars to the economics class that is also taking on special projects for stock market trading. And this is not taught at any university level, and certainly not taught in any of the high schools except for University High School that I know of. And my goal is to try to get this into the hands of the students so that they can get at least a leg up and at least get an introduction to what technical analysis is and how to use it for risk management. So if you know of any teachers, professors, students, and the like, please send me an email at aj@themarketguys. I'll make special arrangements for that to happen. And I couldn't be happier to be able to teach the students just like I'm teaching you. So again, thank you so much for joining us this evening. I had a good time. I hope you did too. And we'll talk to you next month. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.